How to stay safe while investing. Who says playing it safe is boring? Welcome, intrepid investors. Ever wondered if there's a way to keep your money growing while avoiding those terrifying financial pitfalls? Well, you're in for a treat today. We're taking a deep dive into the thrilling world of safe investing, unraveling mysteries and breaking down complex jargon into bite-sized, digestible nuggets of wisdom. We're about to embark on a journey covering everything from understanding your personal risk profile to identifying potential scams and how to sidestep them. Stay tuned, because understanding how to stay safe while investing could be the game changer that sets your financial future on the path to security and prosperity. Investing, by its very nature, involves taking on some level of risk. You're allocating money with the expectation of a future benefit or return. To mitigate this risk, you need to understand the basic principles of investing. It begins with understanding your risk tolerance, which depends on your individual financial situation and your comfort level with potential losses. Once you have an idea of your risk tolerance, you could begin to construct a balanced and diversified portfolio, which is a fundamental tool to manage risk and potentially increase returns. When it comes to constructing a portfolio, one crucial aspect to consider is your investment horizon, which is the total length of time that you plan to hold an investment. Short-term investments might be more suitable for goals that are closer at hand, such as saving for a down payment on a house, whereas long-term investments could be better suited for retirement saving. Determining your investment horizon allows you to align your portfolio with your future financial needs and risk tolerance, leading to more informed investment decisions. The importance of financial literacy cannot be overstated in the investment world. Being financially literate involves understanding various aspects of finance, including the function and dynamics of financial markets, understanding financial statements, and the various investment instruments available in the market. The more knowledgeable you are, the better equipped you are to understand the potential risks and rewards of different investments, making you less vulnerable to fraud and bad investment decisions. There are numerous resources available online and in print to boost your financial literacy. Remember, education is a powerful tool in your investment arsenal. Keep in mind that financial literacy is not a one-and-done achievement, but a continuous process. The financial landscape is ever evolving, with new investment products and regulations continually emerging. As such, constant learning and staying updated on financial news and trends is key. Podcasts, online courses, books, and financial news outlets are all valuable resources that can help you remain an informed investor, ready to navigate any changes in the marketplace. One of the golden rules of investing is, don't put all your eggs in one basket. This means you should spread your investments across various asset classes like stocks, bonds, mutual funds, real estate, commodities, etc. This approach, known as diversification, can help you reduce risk. If one investment doesn't perform well, the others might, and this helps to balance out potential losses. It's essential to diversify both within and across different asset classes. About diversifying within each class. For instance, if you invest in stocks, consider diversifying across different sectors such as technology, healthcare, or utilities. The goal is to insulate your portfolio from volatility to a certain extent, as different sectors can respond differently to economic events. Furthermore, global diversification can provide an additional layer of safety, allowing you to mitigate the risks associated with any single country or region. Regular monitoring of your investments is another critical aspect of safe investing. The performance of your investments can change due to a variety of factors, including changes in the economy, market trends, and company-specific news. Regularly reviewing your portfolio helps you make necessary adjustments in a timely manner, ensuring that your investment portfolio aligns with your goals and risk tolerance. While regular monitoring is vital, it's important not to confuse it with frequent trading or trying to time the market, which can be risky and counterproductive. Instead, consider setting a schedule for reviewing your portfolio, perhaps quarterly or semi-annually, and stick to it. During these reviews, look at the performance of your individual investments and also at your portfolio as a whole. Are your investments still aligning with your goals? Have they strayed from your desired asset allocation? Answering these questions can help you decide whether rebalancing or making other adjustments is necessary. Unfortunately, the investment world is not immune to scams and fraudulent schemes. From pump-and-dump stock schemes to pyramid schemes, there's a range of tactics that unscrupulous individuals use to separate investors from their hard-earned money. To avoid falling victim to these, always ensure to verify the credibility of the investment and the person or company offering it. Be cautious of investments that promise unusually high returns with little or no risk. If it sounds too good to be true, it probably is. Use resources like FINRA's Broker Check and the SEC's Edgar database to check the legitimacy of brokers and investments. Also, be wary of high-pressure sales tactics and unsolicited investment advice. Legitimate investment professionals should be open to questions and willing to provide clear, detailed answers, and they should certainly never pressure you into making immediate decisions. Maintain a healthy degree of skepticism and always perform your own independent research before parting with your money. Remember, in the world of investing, knowledge truly is power, and it's often your first line of defense against scams and fraud. While it's entirely possible to go it alone, many investors choose to hire a financial advisor to guide them through the investment process. If you choose this route, it's essential to find a qualified, reputable professional who understands your financial goals and risk tolerance. A good advisor can help you create a well-diversified portfolio, provide insight on complex investment matters, and steer you clear of potentially dangerous financial situations. Always make sure to check their qualifications, references, and track record. When seeking professional guidance, consider the fee structure and how your advisor is compensated. Advisors can be fee-only, meaning they charge a flat fee or a percentage of the assets they manage, or they could be commission-based, earning money when they buy or sell certain products on your behalf. Each comes with its own potential conflict of interest, and it's important to understand these when choosing an advisor. Furthermore, remember that even with professional guidance, you should continue to play an active role in your financial journey, keeping abreast of your investments and the broader market. It's important to remember that emotions can be an investor's worst enemy, whether it's the fear of missing out, FOMO, driving you to jump into a hot investment, or panic causing you to sell during a market downturn. Emotions can lead to poor investment decisions. One of the keys to safe investing is to create a sound investment plan and stick to it, resisting the urge to make impulsive decisions based on the emotional climate of the moment. One effective way to manage your emotions when investing is by practicing dollar cost averaging. This strategy involves investing a fixed amount of money in the same fund or stock at regular intervals, regardless of its price. When prices are high, you buy fewer shares, and when prices are low, you buy more. Over time, this can potentially lower the average cost per share of your investments, and more importantly, it helps take emotion out of the equation, as you're investing a set amount at regular intervals, regardless of what the market is doing. Staying safe while investing involves a combination of financial literacy, diversification, regular monitoring, avoiding scams, seeking professional guidance when needed, and managing your emotions. Remember, the goal of investing is not just about making money, but also about preserving your capital and growing it steadily and safely over time. Thank you for watching. We hope this video helps guide you towards a safer investment journey. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more insightful content. Until next time, stay savvy and keep investing wisely.